Welcome back, everyone, to part 3 of how to make $700,000 a year as a CFO. My name is Nelson Alvarez. I'm a CPA and executive management consultant. This is the final part of a 3-part training series. So if you haven't watched parts 1 and 2 yet, I strongly suggest you go back and do so, since watching out of order won't make much sense, and I also don't want to repeat myself out of respect for your time. In this video, we're going to fully cover rule number 3, which I've been talking about, which is knowing how the corporate finance game is played. Yes, corporate finance is a game, and you need to know how to play by the rules in order to be successful. The secret to the game is knowing that Wall Street has certain expectations of your financial results that you should be reporting each quarter. To successfully play by its rules and win the game, you need to report results that are reasonably aligned with its expectations each reporting period. And we'll get into that a lot more coming up. Okay, the first question to ask is, how do we report results according to expectations? How do we know what they are? Well, first, you have to reasonably and appropriately cook your books to first meet those market expectations. You'll know your books have been reasonably and appropriately cooked if your results align with your industry and your competitors, okay? If you can feasibly do so. Again, if you can feasibly do so. You can't lie, okay? You can't make up whatever margins you want, okay? If your business is really going down the tubes, you're not going to be able to get away with lying about that, nor should you. What I am saying is that if you have a healthy business, your numbers should be cooked the way the market expects to see them. Now, why does the market want to see numbers cooked or presented in a certain way? It's because of the subjective nature of accounting, first and foremost. Given that there is no accounting instruction manual for every single business transaction and every single situation, and also the fact that GAAP allows accounting managers to have a lot of discretion into how they book transactions, it's near impossible for the market to objectively judge your results without some type of context. That context are your competitors, your suppliers, your overall industry. Again, it's all a benchmark. So for the market to believe and rely on your results, it expects that you will report them in line with your competition, in line with your industry. That's the only way it's going to believe they're truthful and factual. For example, if your competitor shows a 50% gross margin, your margin should also be around there as well. If your competitor shows COGS, cost of goods sold, at 20% of gross margin, yours should probably also align too. Why is that? Because you most likely use the same suppliers and have the same processes, right? It would be unusual if your cost of goods sold percentage was very high or very low compared to your competitors. That's where the question comes in, okay? The market needs and demands comparisons due to the inherent subjectivity of accounting. Again, to beat a dead horse, really, your competitors, your suppliers, your customers, the industry is the benchmark to your results, okay? This is how the market judges your results and determines your stock price, basically. That's a primer on rule number 3. We're going to get into a lot more during the video. To start off our discussion on what the market expects when reporting financial results, I want you to take a look at these 3 examples of a typical GAAP income statement for our example company, Rock Solid Mining. In all 3 examples, we have the same exact revenue, same exact expenses, just spread out over different cost buckets, okay? And the same exact net income at the end. As you can probably see, although we have the same dollar amount of expenses, depending on where you classify those expenses, will change your gross or operating profit margins. Now, margins, particularly the gross profit margin, the GP margin, and the operating profit margin, or the OP margin, are the most important margins that Wall Street looks at. The market expects healthy companies to report particular margins, okay? Stock prices rise and fall based on reported margins. Why? Because margins allow for business performance comparisons among different companies in an industry, regardless of size. They allow the market to say, okay, company X is a leader in GP percentage X, so let's reward it with a higher stock price. The same thing for the operating profit margin, okay? If you have better OP margins than your competitors at a reasonable level, you're going to get rewarded with a better stock price, okay? That's the gist of why GP and OP margins are extremely important. As such, you need to be careful and considerate of essentially where you're classifying expenses, whether that's in COGS or operating expenses, because that's going to change your margins, okay? They're basically like levers, all right? This is really the point of the 3 examples I'm showing you, okay? Depending on where you classify is going to change your margins. Now, you may ask, why does it matter where I book certain costs to essentially manipulate the GP or OP margin up or down, okay? Isn't net income all that matters at the end of the day? Isn't that the most important number that Wall Street looks at? No, that's just not the case. Actually, the net income number is one of the least important numbers on the financial statements. Why is that? It's because the net income number tells us nothing about the operational performance of the business. It doesn't tell me how the business engine runs. It doesn't tell me if it generates cash. That is what is most important. It doesn't matter if your net income is $100 million for the month or negative $100 million for a month. You can technically have $100 million in net income for a month but also run at an operating loss. And vice versa, you could have a negative $100 million net income per month, but also have an operating profit, okay? The gross profit and the operating profit are much better indicators of a business's operational performance than net income ever will be. This is important because our goal as CFO is to ensure that our company is operating at a profit, and that means gross profit and operating profit. So why are the gross profit and operating profit margins better indicators of business performance? Well, let's start with the gross profit line. Now, I assume that most of us understand how an income statement works, okay? But just remember that the COGS line, the cost of goods service line, or cost of goods sold line, is how much it takes to actually build your product. I want you to think raw material and labor. And your revenue minus your COGS gives you your gross profit, or your GP. The gross profit is extremely important because it tells you how profitable your product or service is, ignoring or excluding any other costs, such as executive compensation, rent, or internet expense, okay? It's pure product costs. Now, off the bat, if your product or service on a standalone basis is not profitable, your company won't be profitable, right? It all starts at the top. Now, your operating profit is your gross profit, as we discussed above, minus your operating expenses, okay? The biggest operating expense category is employees' salaries and wages, okay? You also have rent, electricity, utility, insurance, okay? All the costs that go into operating the business, all right? Think of them like pillars supporting your product. That's how you really should think of them and classify them as. All recurring costs not already classified to COGS should be put in the operating expenses, okay, as they help to serve your business operate 24/7. Your operating profit, this is important now, your operating profit tells you how much money is theoretically left over after you have paid all your bills for the period, all right? Tells the world, here's how much money I technically have on paper after I've sold my products and pay my employees. It is a measure of business efficiency. Now that you understand how GP and OP are better indicators of business performance, how are they actually cooked? The simplest way they're cooked is essentially based on cost bucketing, where you're placing certain costs on the income statement. You can see this in the example that I mentioned at the beginning. In the example at the beginning, I had all the same revenue and all the same dollar amount of costs, but depending on where I classify them, whether COGS or operating expenses, gave me different GP and OP margins. Think of bucketing costs like pulling levers that will push one margin up or down. Now, why do I have to decide where costs are bucketed? Now, you don't have to decide where to bucket all costs. For example, raw material and an hourly builder's wages are going to be included in COGS no matter what the industry. However, where it gets interesting is think of the salary of the assembly line supervisor, okay? Or maybe the plant manager. Are we putting those in COGS? Or would you say those are more operating expenses? Those types of costs are not so straightforward. And you could technically make an argument either way, just simply based on the subjectivity of it all. But again, you gotta be careful because depending on where you bucket them, it's gonna change your GP or OP margins. You don't want to be on the wrong side of the margins, whether accidentally or intentionally. If within your industry, the assembly line supervisor's salary is in COGS, yours better be in COGS as well. You don't want to go against the grain of your industry, or else you could be investigated for potential fraud for misleading investors. We saw this happen in our second video of the example of the accounting scandal I gave with waste management, okay? They were just really taking their costs to an unreasonable level, and that's how they got investigated for an accounting scandal. This is why understanding your competitors' financials and your industries is so critical to successfully playing by Wall Street's rules. Now, however, if you truly can justify better margins than your competitors, you're going to have to demonstrably prove that to Wall Street, okay? And that usually takes place through analyst calls, TV interviews, and articles, okay? If you really do have it, go ahead and report it, but just know you're gonna have to substantiate it. Now that you know you have to reasonably align your margins to meet the expectations of your industry, how do you as CFO even know what these expectations are? How can you be sure that before you even report your results, that your numbers are in line with your competitor in your industry? Well, whether it's your first day on the job as CFO or your 10th year, you need to be regularly sitting down with your accounting team and reviewing your costs and your financial statement line items. For example, sit down with your team, look at your GP and look at your OP and ask them, for example, if depending on your industry, are we including the assembly line supervisor salary in COGS or OP expense? If yes, why? If no, why not? What does the market expect? What do our competitors do? You need to ask what other of these undefined costs are we including in COGS or OPEX? What are they and why are we classifying them there? Do our auditors agree with our accounting classifications? What do the consultants say about where we're bucketing them and what our margins are compared to the industry and competitors? The more data you gather, the more information you get on your competitors' industry, the better your accounting decisions will be and the better your results will be. The more appropriate and the more reasonable your books are cooked, the better the job you'll be doing as CFO, and you'll be minting yourself a great reputation. As I've been hammering throughout the course, as CFO, you need to be applying rule number 2 of asking questions and gathering data to ensure that your books are appropriately and reasonably cooked in order to abide by rule number 1. All these rules work together and they work in harmony. Given that all these rules work in harmony, if you're not actually abiding by them, you may potentially commit accounting fraud. Or even worse, in my opinion, you may leave money on the table because your margins could have been better. With that, let's talk about rule number 3 just a bit more to hammer it home. Given that the CFO can essentially craft the financial statements however they see fit, how does the market know those results are truthful and factual? How does the world know that what the company is reporting is not misleading to investors? Well, again, as I've been saying a lot, the only way that the market is going to know if your financials are reasonable is by comparing it to your industry, principally your competitors. The market compares the financial statements of your competitors, suppliers, customers, stakeholders in your entire industry, okay? And what it does is take a reasonable average, essentially, of all the revenues and costs, all right? And this is happening 24/7. As more data gets pumped into the market's analysis gets better and better, especially in your company too, after you just report results, okay? The market is out to validate your results in a sense. The market essentially gets a reasonable understanding of what any one stakeholder in your industry's financials should look like because it has all the inputs and outputs, okay? And your results are simply going to balance the equation. Your financial results will validate the inputs and outputs the market is collecting. It's like a blockchain, basically. The market has all the information whether you know it or not. It knows how much suppliers charge you, and it knows how much customers pay. And how does it know this? Because it's all public information. If you are a public company, you have to publicly provide your financial information to the SEC. So in a sense, the market knows your operations. It really knows your cash flow even before you report results for any given quarter. Again, because of all the inputs and outputs it's collecting, it already has the expectations of what your financials should be, which is why it's important that you align to them. So what types of things is the market analyzing with all this information that it's collecting from the industry? Well, let's say that your competitor has a 50% gross margin, but you have a 75% gross margin. Well, to judge and determine the validity of your results, you're going to get a lot of scrutiny from the Wall Street analysts as they try to determine how your margins are better than your competitors. Given that you probably have similar processes as them, the market is going to dig, it is going to scrutinize, okay? It's also going to perform some forensic accounting to validate your results because in essence, you have unbalanced their equation of all the inputs and outputs they collect on a daily basis. Now, unless, again, as I said, you can substantiate why your margins are better, the market's going to assume that there's some funky accounting going on with there and probably chase after you for some fraud. Again, this is why I preach why it's so important to have reasonable results closely aligned with your competitors, to start at least. Now, if it turns out that your margins are correct, that's totally fine. Okay, your stock's probably going to go up and the market's going to correct for this new data that it just brought in. Given that you have added some new information to the market, it's now going to expect that your competitors can also compete on this margin, again, because you have similar processes. It's also going to expect your suppliers' financial statements to most likely update, right? It's all an interconnected web. Again, this is why if you provide new information to the market that's outside of its reasonability, you've essentially broken its equation. You've unbalanced its equation, and it's going to try and reset, one through scrutiny, or it's going to look at your competitors and say, hey, they're not doing as well as you are. However, as I mentioned at the beginning, to start, you should really stick with the herd until you truly understand what your industry expects from you on a margin basis. Do remember, though, that the market is dynamic. It changes every single day, okay? That's why it's important for you as CFO to constantly be questioning your processes, constantly questioning the numbers, given that the market can change on a whim. This is why having constant and continual feed of an outside perspective in the way of consultants is going to be so crucial to make sure that your books are reasonably and appropriately cooked, so that way you can win the game of corporate finance. Now, it's important to mention that the best CFOs delegate, right? They don't want to be in the day-to-day accounting operations. So how can you, the CFO, set up a system to make sure that this is automatically happening, that you're automatically playing by the 3 rules as I've discussed? Well, you essentially need to teach your team to think the same way as you. You don't want to be making every decision for the organization. What you want to do is push the decisions closer to the people that are nearest to the transactions. You need to teach your team the 3 rules. Show them how to question. Show them how to challenge their own processes and numbers. Give them the discretion to get outside opinion. Give them that discretion to hire consultants. That way they're challenging every aspect of their business so you don't have to. Okay, it's all about being proactive and delegating that responsibility out as a CFO. You need to let them know that the more info they get, the better. The more accurate the results will be, the more reasonable will be, and the better the company will perform financially, okay? The more data you get, the better. Rule number 2, ask questions, gather data. That's all. That's essentially high level how to become and excel as a CFO. I can nearly assure you that if you demonstrate the knowledge and the principles of the 3 roles in an interview for a CFO, they're going to take you in a heartbeat because you're just going to get it. You're going to be one of them. You're going to be someone that doesn't need to be babysat, and you're going to take their company into the next financial future. All right, I hope you enjoyed this training series. Okay, I've got a few more videos coming out soon on financial statement analysis, managing workplaces, interactions and conflicts, and also the best use of data in an organization. That's coming out soon. So if you like the training series, give me a thumbs up, and also comment of what else you would like to see me talk about in the videos, because I'd love to share this knowledge with you. All right, thanks.